Here's the Ticker Time News. I'm Adam, and today's market was marked by a lack of conviction. On either side of the tape, the major indices could not escape their narrow trading ranges and closed with modest losses, except for small caps. IWM was actually up 0.2%. Market participants were playing a waiting game, it seemed, as Fed Chair Powell's speech at the Jackson Hole Economic Policy Meeting on Friday. The 10-year yield remaining above 3%, rising oil prices, and a weak July new home sales report, they all acted as limiting factors today. Market breadth was reflected with the general lack of conviction, with advancers roughly in line with decliners at both the New York Stock Exchange and the NASDAQ at the close. Now, mixed action today left megacap stocks in line with the broader market. Growth stocks in line with value stocks, which is a bit of a change. Today was just a flat, non-existent, boring day in the market. You can see this in the Vanguard Megacap Growth ETF. The ticker symbol is MGK. I'll plug that in here real quick so you can see this. It was up, or down, I should say, 0.3%. The SPX, which is representation of the S&P 500, down 0.2%. The SPY, down 0.2%. The Qs, down 0.08%. And then you compare the mega caps here with, of course, all the major indices to the equal weight S&P 500 equal weight ETF. Ticker symbol is RSP. Guess what that did today? It's probably not surprising since many things else just didn't do anything. It was down 0.3%. So value to growth to mega caps to equal weight, nothing really moved that much today. Now, the Russell 3000 growth index versus the Russell 3000 value index, they closed down the same amount. So again, it didn't matter where you were in the market today, hardly anything budged. Now, notably, though, I will pull up the IWM because even though it was only up 0.2%, it was a gainer today. So it bounced off its weekly expected move on the lower end, but didn't bounce that much. It still left a gaping gap to fill yesterday when things just fell completely down. Now, one thing I want to point this out. Now, even though small caps fared a little bit better today, at least being in the green, the Russell 2000, again, closing up 0.2%. I want to point this out to you. The weekly expected moves, which are the two purple lines going across the screen. This information comes from the options market, as many of you know. And it's a calculation that's done to come up with these numbers. And they're very precise numbers. For IWM, the bottom end of this risk range is 189.68. The top side of this range is 199.62. Now, 68% of the time on Friday at the closing bell, different stocks, different indices, different sectors, whatever it is that you map out with these weekly expected moves, by Friday's closing bell, they close somewhere within this range. And it's basically the risk range for that equity, the stock, indice, sector. It's the risk that the options market is pricing in, saying, you know what? This is where it's going to land. This is where it's going to land by the end of the week. And they're right 68% of the time. But today shows us something that we can learn with the weekly expected moves. I mean, we can see it all in the market. I'm going to go back to the SPX here, which again tracks the S&P 500. And one of the reasons I use this over the SPY is because a lot more money flows through SPX than the SPY. So that's why I constantly am using it as one example. I mean, there are billions of dollars on the line here. And yesterday, Monday, we open up trading, we gap down, and we close just slightly below the bottom end of the weekly expected move. And since this is a risk range for where the options market believes things are going to end up, for the SPX to go from the bottom weekly expected move back up to the top end of the weekly expected move, and for the SPX, the bottom end is 4145.87. The top end is 4311.09. Billions of dollars would need to flow into the market in order to get from the bottom end to the top end of the weekly expected move. So right now, with all the indices practically, except for the Dow Jones and the DIA, the ticker symbol that tracks the Dow Jones, everybody is sitting on the bottom end of the weekly expected move. They're comfortable there. They feel like, well, you know what? Job well done this week. We don't need to go anywhere. This is a safe place to be. Now, things can change. Headlines can come out. The market is really waiting for the meeting or the speech on Friday from Fed Chair. But right now, the market is happy. It doesn't need to move. It's accomplished its weekly goal on the first day of trading. So the only thing that can change this, obviously, is money coming into the market. Headlines changing, or Jerome Powell says something unexpected, becomes more hawkish or dovish. I say more hawkish, or at least staying the same amount of hawkishness that he has been for the past couple of months. The market's happy. It's content. It doesn't need to go anywhere. Now, if there is some unforeseen headline or something unknown about the speech, well, then maybe the market will decide, you know what, we'd like to move from where we are right now. But until that time, the market literally is content right now to sit here until Friday. Now, I'm not saying that that's going to happen. It could just bounce around like this. Maybe tomorrow, instead of being down 0.2%, maybe we're up 0.2%. And we're just hanging around the weekly expected move on the bottom end. Okay. Not a lot of news there, right? I know. It's coming up with today's live stream and what to talk about. It was tough because usually there's things happening in the market to talk about. So I guess there is one area that we could talk about, and that's energy. Because energy was the only area in the market that had a concerted buyer interest. And let's go to it. I'll pull up the other sectors here so you can see them too, and just how flat things were today. Lower this down a little bit. So we have retail up 0.1%. We've got, regional banking down 0.5%. Semiconductors up 0.6%. The dollar was actually down a little bit today at the close. It's now flat. Energy up 3.6%. It was the one thing that actually caught some bids today and moved. So it's something. Now, the S&P 500 energy sector closed way ahead of the broader market. Like I said, 3.6%. But it was boosted by an upside move in crude oil. Crude oil was up 3.5% to $93 a barrel again. Following reports, and remember, we talked about some of this yesterday, about the OPEC Plus and potentially pulling supply. Well, more news came out about that today, and the OPEC Plus suggested that it's likely to cut production or at least reduce the rate of its production. Okay, so the energy sector is now sitting at the top end of its weekly expected move. Now, there is a meeting on September the 5th, and it's an OPEC Plus meeting. I guess whatever's decided at that meeting, it's going to affect energy and, more importantly, oil, of course. If they really do limit production or cut their production targets before the production targets were even, or I should say not targets, but before production was actually increased, then that could send oil back up and, of course, the energy sector back up too. And again, that meeting is on September the 5th. Do you keep up with Euro economy, Adam? They're not doing no, and okay. Yes and no. Let me throw that up on the screen so we all know what we're talking about here. Yes and no. I do follow up with the macro aspect of the Eurozone because a lot of times what happens there happens first, and then it can trickle over to our side of the pond and affect us. And with the economies being ever more global, and I know that paradigm is shifting some and things are becoming more regional, or at least planned to become more regional. Yes, I do keep up with the kind of macro aspect of it, and they are in a challenging situation with a potential hard recession, with the potential energy crisis, is the game they're playing with Russia and their energy, where they're going to get their energy from. It is troubling what is occurring over there. And I do think that our paper recession that we have seen so far, since the euro market and the global economy, I think is going to get hit with a pretty steep recession that will come over to us and hit the US as well. Maybe by Q4 of this year. If not, maybe by the springtime of next year, like Q2 of next year. But I think the real crossroad is going to come at the end of this year, maybe December, January timeframe. Once we're into the winter season, I think that will be the real crossroad, the real, either we're in a recession, we're heading directly to a recession, or the recession's deepening. I think by then we will know. And again, a lot of it has to do with oil prices. As long as oil prices continue to rise, U.S. oil on TradingView, as long as oil continues to rise, like you see here, the past, let's see, how many days is this now? 1, 2, 3, 4, 5, 6. The past 6 sessions, oil has been rising. So has the trend been bucked? I don't know. The 200-day is coming, and we're going to tap it pretty close, pretty soon. Maybe 2 or maybe tomorrow. But we're coming close to that 200-day moving average, and that 50-day moving average is also coming down. So here's that 200-day, and here's the 50-day, and they're about to meet, and oil is about to meet them. The indices, for the most part, hit the 200-day, and that's where the brakes were put on. So if oil finds that same resistance around that 200-day and 50-day, then maybe things won't be as bad. Maybe the recession won't be as bad. But still, that's too, to me, that's too early. I don't think the market has seen its bottom. Therefore, I don't think oil maybe has seen its top. Not 100% sure on that one. I still feel pretty confident that the market hasn't seen its bottom yet. I'm not so confident that oil has seen its top. Maybe it has. Maybe it hasn't. Same thing applies for the dollar. I don't know if the dollar has seen, its top or not. But if oil can continue to rise, then what's inflation going to do? Inflation is going to continue to rise higher and higher. We'll go from 8.5, maybe we're 8.4, or maybe we hang out at 8.5 next month. And then maybe after that, if oil continues to rise, then maybe inflation ticks back up again. And of course, that would freak the market out. And let me pull up the dollar right here real quick. DXY is the ticker if you need it. With that load there. And you can see it ran up today. And let me put it on here so I can see the numbers. So it ran up to a high of 109.27. I said yesterday that, it's either going to run up to that, tag it, and pull back, or it's going to break above it and close above it. But we did make a new closing high for the dollar yesterday after many people, many pundits on TV said the dollar had reached its top. The dollar had peaked back here on July 14th, and it wasn't going to go any higher. Well, the trend's your friend until it's not, and it has been a friendly trend. A lot of rhyming there. So, yeah, I don't keep up with the inner workings, the little stuff in the Eurozone, but the big stuff, yeah, because it can happen here in a couple of months afterwards. Oh, excuse me. So yeah, definitely. Well, honestly, I don't have a whole ton to talk about today because it was a rather boring day in the market. Treasuries, talk about those for just a moment. Treasuries did make a pretty big downside move this morning after some weak economic data, but that didn't maintain its downward momentum. Let's pull up the 10-year US one. Oh, gotta get the cursor back. US 10Y. With that load there, the 10-year, it is steadily marching higher, and I think there's a real big possibility that the 10-year here, it can continue marching on. Most definitely. What is it at right this moment? 3.057, call it 3.06. So it hit 3.07 before the economic data this morning, and then fell to 2.99%, and then it settled here at 305 at the close, and it's at 3.07 in the after hours. And then the 2-year, and I do, in the short term, I do want to see this 10-year continue rising because I want to get out of this yield conversion. Now, the 2-year US 02Y is a ticker you can use. It was at 3.32% ahead of the reports this morning, and then settled at 3.28%. And it's up a little bit more right now in the after hours, 3.3%. Now, that economic data this morning, new home sales was one of them, but we also had some info on manufacturing and services. But one thing real quick here about the 2-year is this resistance needs to hold, and it needs to be stopped right here. At least that's what I'm hopeful for, that the 2-year can be held at this resistance. But the longer it moves sideways, okay, the longer it moves sideways, that 20-day, that 50-day moving average is going to slowly tick up to it. And that's what I'm a little concerned about, because if we look at the past 3 times the 50-day moving average has come in contact, right here, it dipped below it for a couple days. Right here, it never did dip below it except intraday. And then right here, totally bounced off of it. So I don't want to see this, wedge starting to form here with the moving averages and then push the 2-year up higher. I want this to come back down so we get out of the inverted yield. Now, did you get into XLC today? I did not, because I just didn't see this market this morning taking off anywhere. So I did not get into XLC. I am still definitely interested in this, because even though it broke that trend, let me get that out of here. Even though it did break the trend, all right, come on. I am still on the side of the options market getting it right. Now, remember, the options market is practically got a 68% win rate. So with XLC, and this is your communication services, with it down here, way underneath the weekly expected move on the bottom side, by Friday, this thing can come right back and settle right back in here. Now, I know on this trend line, it's been broken now. It didn't hold up. Sometimes that happens. That's okay. We don't win them all. But there are these gaps that were left here, and there's some pretty big gaps. And let me move this. There we go. There's those 2 gaps that were left. Gaps get filled. So I'm thinking this could creep up, if we get some action tomorrow, potentially in the morning, jumping in to ride this back up into the weekly expected move. I mean, it's only about not even $1 move to get back in there. It's 55.56 right now, and the bottom end of that weekly expected move is 56.32. So this one is still attractive to me risk reward wise, but not quite there yet. I would like to see it at least start to turn green and hop on board as it's moving, and end up back within the weekly expected move on Friday. Now, when it comes to Friday, there's a lot of investors, market participants who are worried sick about it. I don't think Jerome Powell is going to. Here's something. Let me just say this. It doesn't matter what Jerome Powell says. I already know, or my market thesis tells me, this market, the economic conditions, they're all weakening. They're getting worse. Housing market, it's getting worse. This market has not seen its bottom yet. And like I just mentioned earlier, I think by the end of this year, by December, we should see either a recession that we can't ignore, we can't change the definition, it'll be undeniable, or we don't. But I think by December, we will know. Now, the worst of it may not even come this year if we do face down that recession. That may come some point next year. So by December, we should know whether it's a recession or not. And if it is, then I don't think the market, even by that point, will have seen its bottom. There's just so much happening in this market. I think too many market participants are looking through rose-colored glasses, thinking everything is just rosy. Everything is great. That jobs report, I don't know where they got that number from. But the more that I dig into jobs, the more things don't add up. 500,000 jobs added, yet companies are freezing hiring and laying off workers. Have you heard of a single big name company saying they are increasing hiring? Just one. I haven't. But there's a whole list of companies that are laying off or freezing hiring. So if companies are laying off and freezing hiring, and this is a big bit of news, and I have not seen it in any mainstream media whatsoever. Amazon, this last quarter, laid off 100,000 workers. 100,000 workers laid off at one company in one quarter. Why is nobody talking about that? So where did they get this 500,000 jobs number from? I don't know. But reality doesn't match up. Yeah, a lot of data doesn't make sense. Yeah. A lot of it doesn't make sense. Which has this market, I think, overconfident. I mean, the market front had a beautiful summer rally, but reality is going to set in. And once reality is set in, you know, the market is going to have to face the realization of where we really are. Who knows? Maybe Friday, maybe Jerome Powell is going to come out and say something completely off guard and catch the market off guard. And maybe it'll start coming to a realization then. We need to see earnings estimates come down. And if we're going into a recession, there's no way companies can keep up these great earnings. I mean, look at the housing data today. New home sales came out today, and it declined 12.6% month over month in June. 12.6%. Now that works out to a seasonally adjusted rate of 511,000 units. The expectation was 580,000 units. That's a big miss. And then if you look at a year-over-year basis, new home sales were down nearly 30% from this time last year. Nearly 30%. I think this reflects the adverse impact of rising mortgage rates, high home prices, pushing down demand, putting people into positions where they can't afford to buy a home. And that impact is evident in the increased supply of new homes for sale. So that's not the greatest of great things. Now, tomorrow, there's not a lot of data coming out tomorrow. And I do believe tomorrow could just be another day like today, where not many things move at all. And as a matter of fact, they probably won't. Lots of big names laying off. Amazon is like the barometer of the economy. Yeah, Amazon is just like Walmart. I'm a little more old school when it comes to Walmart being a barometer for the economy because they, everybody shops there. But you're right. You're absolutely right. Amazon is one too. More and more and more and more people are going to shopping on Amazon and, picking things up there. But at some point, this market has got to come to the realization that things are not as good as they hope or think, or I don't know why. But I mean, you guys know. I don't have to shrink up the chart here for you guys, because you guys know what's down there. I haven't changed it. I haven't moved it. It is still sitting down there, even with this big rally that we just had. And since we had the big rally, that means it's gonna be even a bigger fall to get there. But I still have that yellow box down here. I still have that yellow box. I mean, goodness, I haven't measured it in a while. Let's see if I can't do this make this a little better. Let's see, where are we now? Right here. $32.50. It's a 21.6% drop from where we are right now. Did I say 21? I'm sorry if I did. 32.50. 32.50. I think that's where we will be mid-October. I think that's where the market will be. And the longer the market waits, the harder that drop is going to be. I mean, when we took this tumble right here, when we had those big down days right here, let's see, that finally, I guess that was about a 9.3% move right there, give or take. And we are starting to run out of space here. Mid-October isn't that far off. I guess what do we got? A month and a half before we get there. And if we drop to here over the next month and a half, that's a hard fall. That's a hard fall. Maybe this might have to get adjusted here, but for now, that's where it's at. So, yeah, Amazon definitely. And Amazon laying off 100,000 employees in 1 quarter. That is a lot of cuts being made from a massive company. And if they're making those cuts, then they see the writing. All of these companies who are making cuts, who are putting freezes on hiring, who are pulling money out of projects, they all see the writing on the wall. They know what comes next. I don't know why Wall Street is being stubborn about this. It's how I think they are. They're being stubborn about this. Not facing reality, not looking at the data objectively. They have too much emotion into this, thinking that the Fed is going to pivot. There is not a chance that the Fed is going to pivot. And when they say the Fed's going to pivot, do you guys realize what happens in September? When the pandemic hit, we had unlimited QE. And QE is quantitative easing, okay? That's basically the Fed putting money into the market. They're buying up assets to put on their balance sheet, okay? Which is putting money into the market in simplest terms. QE has been ended, right? But QT, quantitative tightening, that's when the Fed starts to offload assets off of its balance sheet and sucks money out of the markets. That has barely begun. But in September, QT, quantitative tightening, is going to step up its pace to, I believe, 95 billion per month is going to come off the balance sheet. That's a lot of assets being sold. When money like that is coming out of the market, what's that going to do to the market? And another thing too about the QT, I don't think a lot of people heard it, but it should have been front page news the day after. But at Powell's press conference, not the most recent one, but last month, when talking about quantitative tightening, how long did he expect the quantitative tightening cycle to last? Over a year and a half. Maybe even up to 2 years or longer. So if the Fed is, clearing up its balance sheet, and they're going to be doing it for a year and a half or 2 years, or who knows how long it's actually going to be, that's not good for the markets, even in the long term. Or I guess maybe medium term, like over the next year or two. So people got to wake up and pay attention. Stop wishing for the best. I understand when the market goes down, it's painful. 401ks get hit. And that's the most unfortunate part about it, because, people who are investing for their retirement using 401ks, they don't keep up with the financial markets day in and day out like we do. They check in on, their account maybe once a quarter, once a month. They see it's falling. They see how far it's gone down this year. That hurts. And to me, that's one of the worst parts in the financial market, are those who are expecting that when it comes time for them to retire, they can count on their 401k. But if the market has been in a bear market, like it has so far this year, and their accounts are negative, and oh man, the beginning of the year, we were at that right number where we could retire at the end of this year, but now that the market's gone down, we're not at that right number again. That's hard. That's hard. Okay, as you guys can see, I really didn't know where or what direction I was going to go in today. I had no idea what to talk about because, again, there was hardly anything, really out there in this market besides energy making any type of big moves. Tesla does have, on Thursday, a stock split coming up, TSLA. So that'll be interesting. I don't know how it's going to react. Did I not get? Nope. There we go. I believe it's the 25th, which is Thursday. There is a stock split going on. for Tesla. Not sure how that's going to affect price for Tesla. I mean, it shouldn't, because it changes nothing fundamentally about Tesla. But yeah, and yep, there it is on TradingView already. August 25th, so that's Thursday. 3-for-1 stock split. So Tesla's price of $889, that'll be chopped into 3, lowering the price again, which is, the stock splits, they're healthy for the market. They're healthy for investors. Without this stock split, stock prices would just go up so high that very few could be able to buy, multiple shares. They would all be buying fractional shares. I mean, just look at, Warren Buffett and, man. All right. So, yeah, I honestly, I apologize for such a lame live stream today. Very mellow day in the market. No real trades taking place. Because things just weren't moving enough. The volume is way down. Look at Tesla's volume here. It's 21.3 million. Average volume is 27.5 million. So big drop-offs in volume. Declining volume even in the main indice products like SPX. Volume is declining. So it's like investors themselves, market participants, don't know what to do. Okay. Let's see here. Yeah, Berkshire Hathaway. Yep. Even small caps were a snooze. Yeah, it was just it was rough. Can buy 1 share for a price of a house. Yeah. Yeah, because that's what happens if you don't have stock splits. So they are healthy. And they allow people to, purchase whole shares and not just fractional shares. Which was a game changer. Fractional shares, that was a game changer for the market. That allowed retail to come into the market, which was a good thing. I think the more people who are educated and are in the market are much better than those who have no idea. So, okay. Well, if there's nothing else, I guess I'll cut this one off short today. Maybe we'll get some movement tomorrow, but I'm not anticipating it. With what happened today, it looks like market participants are just holding back and waiting for Papa Powell to make some declaration on Friday. Probably not a declaration the market wants to hear, quite frankly. And since the market is already sitting at the bottom end of the weekly expected move, if we don't get some upward momentum tomorrow or Thursday, then if Jerome Powell does say something negative, then the options market got this week wrong. And don't forget, the market's going to come down. The timing, only God knows. I have no crystal ball. But we do what we can each and every day. We try to learn and do better the next time. All right. Well, again, sorry for a boring show today. There's just not much really going on to spice it up. But I'll be back here tomorrow after the market's closed, and hopefully the market had some action and we can, make some trades out there. So I thank you. I appreciate you being here, even if it is a boring show today. I definitely appreciate each and every one of you. So thank you for joining me. I will talk to you again. Members in Patreon, which, you know what? Discord, I'm having trouble understanding those bots. Maybe I don't need bots for Discord, but there is a Ticker Time News on Discord. I'm just not understanding the bots. There is like so many of them. Some of them are free, some of them you have to pay for, and I'm finding myself a bit overwhelmed with that. I would love to get Discord set up, so we have a place that's from what many seem a better place to communicate and share ideas. And I have not given up on it. I'm just having trouble understanding whether I need any bots or not, because everything I read, or different sites I check out, need to have a bot to control spam, and this one's got me a little stumped. So I'm trying to work through it, trying to understand it, so we can at least have Discord and maybe be able to build a better community there, because that's my goal. I just want a place for investors to yeah. You don't need bots. Okay, that's interesting. Just started to use Discord about 2 months ago. Okay. Okay, if bots aren't needed, then there is a Discord set up. I guess I can link it with the Patreon. That seems to be like a very simple, and it might already be linked. I have to double check. But there is one set up already for Ticker Time News. All right, I'll see if it's linked or not to Patreon. If not, I'll go ahead and link it. But yeah, it's already here. Okay. All right, I'll work on that this evening and make sure it's good to go. I won't worry about then bots, at least for now. And yeah, so we'll have that. Okay, well, I'll wrap it up here. Again, sorry for a boring commentary today. Hopefully there's some action tomorrow. We can trade tomorrow, at least on something. And who knows? Maybe it's just going to be another flat day, maybe in the green direction tomorrow. But all right, that's it. I'll see you tomorrow after the market's closed, and have a good evening. Thank you.